Morgan Stanley Wealth Management Global Investment Committee, January 2025. Lisa Chalette, Chief Investment Officer, Head of the Global Investment Office, Morgan Stanley Wealth Management. Daniel Skelly, Senior Investment Strategist, Morgan Stanley Wealth Management. On the market. 2025 is showtime for fundamentals. The bull market that began in October 2022 has been noteworthy in many respects. While many have focused on gains among perceived winners of the AI revolution, the so-called Magnificent Seven, less discussed has been the extent to which market action has diverged from realized fundamentals, instead anticipating Goldilocks conditions to be enhanced by a new administration's growth policies. While nominal GDP has grown at a relatively robust 5.5%, 6.0% rate the past 2 years, two-year trailing S&P 500 earnings growth is only 7.6%. This suggests that operating leverage resulting in profit margin expansion has been historically modest, and that most of the market move has come from multiple expansion to a level that is rich absolutely and versus interest rates. To wit, the 10-year Treasury yield is 65 basis points above where it was at the 2022 bear market bottom, and the equity risk premium has shrunk to only 4 basis points. Meanwhile, coronation still above the Fed's target has frustrated anticipation of much lower rates and further easing. With these constraints on the ability of monetary policy and valuation expansion to drive gains in 2025, the baton is passed back to fundamentals, or corporate earnings, where expectations are lofty. The consensus for 2025 and 2026 calls for a two-year earnings growth rate of 30%, roughly 4 times that of the past 2 years. Certainly, scale policies like tax changes and deregulation could be positive catalysts, as could recovery in rate-sensitive sectors and improving global growth. But here, too, investors should be measured. Decisions are likely to constrain tax cuts, and the economy's rate sensitivity may be muted by structural factors like a frozen housing market and income/wealth inequality, as U.S. dollar strength increasingly makes used goods unaffordable to foreigners. Uncertainties around the pace and sequencing of the Trump agenda bear watching as well. We conclude that success in 2025 will likely depend on stock picking and security selection, accompanied by realistic expectations. Focusing on balancing value and income/cash flow generation with price appreciation leads us to suggest our most diversified portfolio construction of the past decade. Noting that avoiding extremes will be key, we have recently added to U.S. value stocks, mid-cap growth, select international names, real assets, hedge funds, and targeted private market opportunities. Coupon clipping in corporate credit and municipals still holds appeal.